One question that I get asked a lot is, Julian, how do you do scalping? Especially if the market is trending upwards or if I just want to get a quick in and out. Hey YouTube, Julian here, and in this video, I'm going to be sharing with you not one, but two of my favorite scalping strategies that I've used to turn $82 into $10,000 and also to pass problem challenges like this in the video. And it is also responsible for students' results like all these that you see on the screen. So it's quite powerful if you use it right. Now, before I begin, make sure you take out your notebooks, your pens, write down notes. I'm going to be as raw as possible and let's get right into it. Now, if you like videos like this, I'm going to give you 5 seconds. Help me out by clicking subscribe and also commenting more so that I can produce more videos like this for you guys. 5, 4, 3, 2, 1. Without further ado, let's get back into the video. Okay, so let's talk about scalping gold. Now, this strategy that I'm about to share with you is mainly meant for gold because that's the main asset class that I use to trade. I'm not sure how well this strategy works with other asset classes that you have to test by yourself, but I know this works very, very well with gold because I've been using it for a very, very long time. Now, for those of you who are new, who don't understand what is this scalping, let me give you the textbook definition of what scalping is. Scalping is basically a strategy that traders make smaller profits by quickly buying and selling. So as you can tell, this is a higher frequency trading that goes along, and this small profits is the textbook definition. Of course, there are times that you can also make a lot of profits as well, but why is it called smaller profits is because the movement is lesser, right? And because of this, we are actually using a smaller time frame in order to trade, in order to get in and out very, very quickly. And when I talk about smaller time frame, what is the time frame that I'm talking about? I'm mainly referring to M15. Sometimes you can do it on M5 as well, but personally for me, I like to do it more on M15. And when we talk about smaller profits, we're aiming for at least a 30 to 50 pips movement. Obviously, when you're trading a smaller time frame, this also requires you to monitor a little bit more. This is not the same as a set and forget strategy. I have different strategies that I teach. This is not the same. This requires more constant monitoring. But if you are one person that again likes a fast in and fast out, then pay attention because this is going to be very, very important. Now, let's talk about my first scalping strategy, which is the M15 SRR and RSS. Now, for those of you who have been following me for some time, you know that I trade SRR and RSS. Very, very simple strategy. Let me just quickly give you a quick refresher if you don't remember what it is. Basically, when it comes to SRR buy, we are actually looking out for this pattern. A support that breaks through two resistance 1 and resistance 2. Looking out for a new resistance to be formed, and when price comes back into the support area, this is what we're going to be doing. We are going to enter buy at this area. Why? Because inside this area, there are going to be market orders, especially when there is a breakout that's being formed. There's going to be a lot of market orders that have been collected. When price comes back in, they're going to collect all these market orders and price is going to push up. I've got a video that you can watch right here, so do pay attention to that. But very, very quickly, R2 must be higher than R1 because it needs to break through two resistance. Next, support that leads to NR. This support that leads to NR has to be a continuous big movement. You want to see a breakout that happens, that breaks out above R2 and R1. And then NR, this one here, must be higher than R2 and R1. If NR is the same level, it does not mean that it has broken through two resistance. It has to body candle close above for it to consider as being above R2 and R1. And also one more thing is that I'm looking for the wicks of R1 and R2. That is what I consider as the resistance. And where do we buy? We only want to buy at the support area. Now, another thing is the valid area is going to be from S until R1. So the area can be slightly bigger, depends on the range of the zone. So let's go through the chart right now and see if there are any examples to show you guys. As you can see, I'm on M15 right now, and we're going to be looking for examples of SRR buy for you guys. So right here, you can see that this is a very simple and straightforward SRR buy. This is a support that breaks through resistance 1, resistance 2, forms a new resistance. Notice that I'm using the wicks as the top of the resistance. This one right here as well, wicks as the top of the resistance. For those of you who are unfamiliar with how to find the resistance, basically we're looking at green to red, because when green candle goes up, red candle comes down, this forms the tip of the A, right? If it's consecutively green candles, it means that price is going up. So that's not a resistance. Like this, there's no resistance inside here because it's consecutive price going up. We want to look for price to go up and then come back down, right? So back to this again, as R1, R2, new R. And right here, we want to look for this area right here. Notice how price comes into the support, pushes up, and this will actually give you a very nice 100 pips, right? This itself give 100 pips. Now, obviously, if you didn't enter such a low area, maybe enter slightly higher, this is also 100 pips around there, right? If you enter at the top here, this also would have given you about 60 pips. But what we're aiming for is just 30 to 50 pips. If you can get this, that's good enough. Let's see other examples. Right here, you can see another SRR, very straightforward. Support that breaks through resistance 1, resistance 2. So notice this is the price that goes up, come down. This is the price that goes up, come down. That's why this is resistance 1 and resistance 2, forming a new resistance. So what we do is we are just marking the support area, right? Support, go all the way to R1. Okay, so you can see right here, this price came all the way here, went up. This is M15 SRR. Very straightforward. This setup alone gave a very nice 200, 300 pips even. But again, because we are scalping, we can just aim for very quick 50 pips and that'll be good enough. Right here, another very straightforward one. Support that breaks through resistance 1, breaks through resistance 2. New resistance. So right here, we are looking out for the entry at the support. So right here, price came in and all the way up. So some of you may ask me, Julian, where do you put your stop loss? Usually I will put my stop loss about 20 to 30 pips below the end of the week. So this is the end of the week. You can just look at 20 to 30 pips below that. So this will be about 20 pips. So you can see right here, this is how the trade actually went. Let's just say you went in the trade at the middle. The stop loss is right here. This actually went all the way up until 1000 over pips. But again, if your target is just 50 pips, there you go. This is target hit. Over here, very straightforward one again. S, break R1, break R2. New resistance. Right here, we have a very straightforward entry. So I normally just mark the body all the way to the end of the week. Put the stop loss 20, 30 pips below this. Let's just say you entered in the middle here. You can see right here, 20 pips below would be somewhere here. This would have given us a very nice 50 pips would be around here. There you go. Right? So this is a very nice 1:1. Obviously, this trade did go further as well when even up to 1:2. But again, if you're scalping, just a very short 30, 50 pips, that would be good enough. Usually 50 pips would give you at least 1:1, right? Okay, so next would be RSS sell. Basically, similar thing, just the other way around. We're looking for a pattern similar to this. Basically, what we want to look out for is a resistance that breaks through two supports, support 1 and support 2. Wait for a new support to be formed. And then when price goes all the way back to the resistance, this is the area they want to sell. Also, similar to before, valid area would be until S1. But again, if the zone is too big, try to make it a little bit smaller by using the body until the end of the week. And this is where all the sell orders would be. Once price collects all the sell orders, it will then go all the way down. Similar to just now, criteria one is S2 must be lower than S1 because it needs to break through two resistance. If S1 is same length, then we don't count it. And what we want to look out for is the wicks for the support. Next, R that leads to NS. R that leads to NS. This must be a big movement, a breakout, and it has to break past two supports. NS must be lower than S1 and S2. So NS has to be below S2 and S1. Body candle must be below. It cannot be S2 wick is lower than NS. And what we want to focus on is to sell only at the resistance. Let's head over to the charts and let's see how we can spot this. Okay, there is a very nice RSS on M15 right here. You can see resistance breaking through palm. Support 1 and support 2 forming a new support. So what we are doing is we're going to mark this right here. So I mark the body, whichever is smaller. So you may ask me, Julian, should you mark this one or should you mark this one? I just pick the smaller one so that it makes my zone smaller and I have to be a little bit more precise. So what's going to happen is that I'm going to put my stop loss 20 to 30 pips above here. So 30 pips, in this case, it would have hit stop loss, right? So is there any big deal? Not really, because this is a small time frame trade as well. So if you want to make it a little bit wider, you can do so as well. And also, I believe this area here was a big movement because of the news. So shit happens. But regardless, look at how far this actually went down. Exactly at this area, went all the way down 500, 600, 700 over pips with this RSS. So if you want to increase the stop loss a little bit, well, you can do that as well. I'll leave that up to you. Let's have a look at another example. So over here, you can see R, break S1, break S2, break S3 even, new support. So where would our entry be? This entry would be at the resistance over here. Normally I put it at the body to the end of the wick. And right here, what do we see? We see price tap into this area, went all the way down 60 pips, right? So we still hit our target of 30 to 50 pips. Now, since we are here, let me show you what is not an RSS. Resistance breaking through support 1, support 2. Now, notice support 2, the wick is below the new support. New support, I look at the body, right? I need body candle close to be below. Right here, this is a clear example that S2 is lower than NS. So that's why I don't consider this as a proper RSS. Right about here, R, break S1, break S2, new support. So where is our entry area? Our entry area is right about here. In this case, 20 to 30 pips above the highest wick, which would be, I would use this one actually, 20, 30 pips around here. In this case, it tapped the stop loss for just a bit before heading down. Well, again, shit happens, but if you would want to raise it up to 40 pips or 50 pips even, I believe that would be fine, because you can see right at this area right here, went all the way down 300 over pips. So it would be unfortunate if you had put a very tight stop loss and in the end missed out on a 300 pip move, right? Let's see if I can find another example. R, S1, S2, new S. Right here, I'll take the body until the end of the week, whichever is smaller. And right here, we can see very nice, boom, 80 pips move. Simple. Simple strategy using very basic SRR and RSS. Now let's move on to strategy number 2. Strategy number 2 would be M15 FVG. Now, I'm not sure if you guys are familiar with FVGs, which is fair value gaps, but I love to scalp on the M15 FVG. Now, just a quick refresher in case you don't know what are FVGs. FVGs are a basic 3 candlestick pattern. For example, first, second, third candle. What we are doing is we are looking at the top wick of the first candle and the bottom wick of the third candle. Anything gap in between would be what we call as a fair value gap. Now, very important to note that we only look at the middle candle to determine whether is it bullish or bearish. The first and the third candle doesn't really matter. It can be a red candle. It can be a red candle on the third candle. It can be first and third being red as well. It doesn't really matter. You want to look at the middle candle. As long as it's green, this is what we call as a bullish fair value gap. So let me show you an example in the chart. Right here, you can see that this is the first candle. We want to mark the top wick of the first candle. And this is the second candle. This is the third candle. We want to mark the bottom wick of the third candle. Anything that is in between right here, this is what we call as the fair value gap. So how the fair value gap works is basically there's a push up, and this leaves market orders inside of here. When price comes in, taps in the fair value gap, price is going to push up. Think of it like a resistance that has been broken out. So when price comes back to this resistance will now become a support, and price will push off from this support to the upside. On a similar note, there's going to be a bearish fair value gap as well. So bearish fair value gap consists of a 3 candlestick pattern. However, instead of the top wick of the first candle and the bottom wick of the third candle, this now is reversed. So you need the bottom wick of the first candle and the top wick of the third candle. The gap in between is called the fair value gap. Similarly, we don't need to look at what's the first and the third candle like. It can be green, it can be red, doesn't really matter. We only look at the middle candle. As long as it's red, we call this a bearish fair value gap. So here's an example in the chart. You can see this is the first candle, this is the second candle, this is the third candle. We are marking the bottom wick of the first candle and the top wick of the third candle. This gap in between here is called a fair value gap. So as you can see, price came in, tapped into it, went down. Second time, tapped into it, went down again. Now, there will be times that you notice 2 consecutive fair value gaps. Like in this example, when price pushed up very quickly, it created 1 fair value gap here. Price pushed up again, it created a second fair value gap. In this case, the one that is nearest to the top will be the one that is most important, because you can see right here, price came in, tapped into this, pushed up. We don't look at this one here. We only want the top one if it is a bullish fair value gap. Of course, if it is a bearish fair value gap, then it will be the opposite way around. This is only relevant for consecutive fair value gaps. Now, a question that people always ask me is, how do we consider that the fair value gap has been invalidated? How do we consider it as it being filled? Now, it's considered as a failure of the fair value gap when the body candle closes past the fair value gap. Let me give you an example. So in this screenshot right here, firstly, we want to identify where is the fair value gap. Notice this is the first candle, bottom wick of the first candle. This is the second candle. This is the third candle right down here. We are marking the top wick of the third candle. The gap in the middle is called the fair value gap. So right here, you can see price tap into the fair value gap. It pushed downwards. At this point, it went in again, collected some more sell orders, pushed downwards as well. Collected more sell orders, pushed downwards. So at this point, it did not break the fair value gap because candle did not close past the fair value gap. When did candle close past the fair value gap? This one right here. When price broke through the fair value gap, it invalidated it. So this is when this fair value gap gets invalidated. So I will always recommend that if you want to use this strategy, make sure the fair value gap is fresh. That means you only enter it the first time it taps into the fair value gap. Now, if it has tapped into the fair value gap before, don't enter. You only want to make sure you enter it when it is fresh, meaning the first time it taps into the fair value gap. Like in this case, this was when the fair value gap was tapped for the first time. You can see price came down. All this would be the second and the third and the fourth whatsoever time. I consider that as already being utilized. I will not enter at any of these points because there would be a chance that it would break, like what happened over here. Now, here's a bonus tip for you. Anytime the price closes inside of the fair value gap, there is a higher chance for the fair value gap to fail. If it just leaves a wick behind, that's fine. But anytime candle closes inside, then there is a chance for it to fail. Let me give you an example right here. Notice how the first time when it taps into it, this left a wick. However, when price came inside here again, the candle actually closed inside the fair value gap. This gives a hint that the fair value gap is going to be invalidated. Look at this. It tried to close a bit higher and also still inside the fair value gap. And what happened? This time over here, it broke past the fair value gap, invalidating it. Let's look at this example right here. Now, if there are consecutive fair value gaps, like in the example that I shared with you earlier, again, we only want to take the top one. When is it fresh? When it touched it for the first time, like so, you can see price did go up. However, when price closed inside the fair value gap, like here, you can see this actually failed the fair value gap. It closed below it, and therefore this also will invalidate the subsequent fair value gaps as well. So when the first one fails, the second one will fail as well. So that's the reason why we only want to take the top one or the latest one. So you can see right here, this also showed that this fair value gap has failed because the candle has closed below it as well. Now let's look at the charts to see if we can spot any opportunities, and I can give you any examples. So right here, we can see a very nice bearish fair value gap being formed. Look at price tapping inside, going down. How many pips is this? This would be 100 over pips. Again, if you're scalping, we just want to wait for 30 to 50 pips. That would be good enough. Where is the entry point? The entry point is anywhere inside the fair value gap. Let's look for another example. Right here, we can see another fair value gap. So where's the fair value gap? This one right here. In this case, there is no top wick. So we take the top of the body. That's still fine. And we take the bottom of the third wick. Look at this. Price came in, tapped, went all the way up. So how many pips is this? This is actually 90 pips movement. There's one more here as well. So as you can see, price came inside, tapped into this fair value gap, went down. Now, if you want to check and see whether it actually went 30 pips or not, let's have a look at the smaller time frame. I'm just going to go to 1 minute. So right here, we can see that price came all the way to the top here and went down. This, if you entered inside the box here, it went all the way down 50 pips. Let me give you one more example. Over here, there's an M15 fair value gap. Price pushed above this. When did the price tap into the fair value gap? This candle right here, tap into it, pushed up. How many pips is this? Let's take a look. 70 pips movement. There you go. Now let me give you a bonus tip right here. Notice that this right here is a fair value gap. And what happened is that this candle closed inside of the fair value gap. When this candle closed inside the fair value gap, remember it says that there is high chance for the fair value gap to fail. Notice what happened. Eventually, this fair value gap broke and failed. This is the candle that closed above, rendering this fair value gap invalidated. However, when this fair value gap, bearish fair value gap, was failed, it actually also created this fair value gap right here, which I can mark it for you at this point. This creates what we call as a balanced price range, BPR for short, when there's two overlapping fair value gaps. Again, this is slightly more advanced, but I hope that you're following me. When we see a balanced price range, always the latest one will take precedence. This happened first, so this is the first one. This happened later. I consider this as the second one. So the later one, the second one, is the one that takes precedence. So what does it mean? You can see right here, if I pull this all the way to the right, notice how this fair value gap that was created later gets tapped into. Price went all the way up from this fair value gap, moving up 120 pips. Even if you entered at the top right here, this also would have given you a very nice 100 pips. But if you're just scalping 50 pips, you're done, move on. Right here is another example. This is a fair value gap. Price tapped into it, went down. How many pips did it go down? This actually went down about 50 pips. There you go. At the dot, 50 pips. And this candle closed inside the fair value gap. When this candle closed inside, it created another fair value gap. Look at this. Again, we call this as a balanced price range because there are two fair value gaps that are overlapping each other. So remember what I said about the overlapping fair value gaps. The latest one would always win. So when this fair value gap gets created, notice how there's overlapping fair value gaps as well. Not here, but here. This is a consecutive fair value gap, and then this broke through, creating an overlap. So the first one, which was here, got overlapped with the second one, and the second one now gets overlapped with the third one. So the latest one always takes precedence. Look at what happened. Price came in, tapped into the fair value gap, went all the way down. It came to the third fair value gap. The last one will always be the winner. Let's look at other examples of fair value gaps. Right here, big fair value gap. You can see this candle was supposed to come down. However, because it closed inside the fair value gap, this gives a hint that the fair value gap has a higher chance to fail. Look at what happened. Price did not go down, but it continued playing higher and higher, eventually breaking this fair value gap right about here. So it did not go down, but failed the fair value gap. How do you know it's going to fail? Because price closed inside the fair value gap. So maybe you can use this as an exit. You don't have to wait until the fair value gap closes before exiting. Now, I wouldn't have entered into this position as well because you can see the zone right here, which is the entire fair value gap, would be too big. It's from 4570 all the way until 4607. It's literally 300 over pips. So why would you want to enter such a massive zone? So tip for you, choose your zones wisely as well. Don't just anyhow enter just because it's a M15 FVG, right? You need to be smart because we are just scalping. You don't want to be over risking too much. Right here, one more example, bearish fair value gap. As long as it's not tapped, it's still valid. So when did it get tapped? Over here, you can see price came in, tapped just the tip of it, went down 100 pips. This one here would be a second entry. I consider this as a little bit risky, high risk. You can see right here, it tested multiple times and it didn't go as far as the first one. It just moved like 70 pips. Obviously, this one would have been a better entry. This would be second. So I wouldn't have entered right here because after this, look at that. Price broke the fair value gap and went up. Now, if you've been following me on my Instagram, you will notice that I've been sharing a lot of my wins. Every single day, I post my wins. And some people have been asking me how is it that I'm doing this? Now, the thing is this, I am not able to share signals because of the current regulations by the government, Malaysian and also Singapore government. As you can see right here, there is strict rules that disallow any sharing of signals. And as a financial influencer, you have to be licensed, you have to be regulated, so on and so forth. That's the reason why I am not able to give any signals as I used to in my public Telegram channel. But here's something that I want to do differently. I want to actually do a journey whereby I show you how I grow an account from $1,000 to $10,000. Now, just to share with you, this journey has already started. We're actually right now on week 2 as I'm recording this. And let me just show you how it's like in the journey. So you can see right here, I'm now up by 2,700. We started off with $1,000 just last week. I did my first withdrawal even, and we continue on from there. So you can see this is one of the recent trades that we actually took, 180 pips, done and dusted. Let me just walk you through a little bit. You can see right here, this is how it looks like. I actually also share what I'm looking at as we progress, because this is really me sharing the journey of how I'm actually doing it. This is another trade that hit 100 pips full TP. And you can see right here, I also post the daily wins that I actually have right here as full transparency. Now, you may be asking me, Julian, how much is it to join in this journey to see your progress as you take it to $10,000? Here's some good news. It's actually free to join. Now, this group that I'm doing, I have to be really selective on who I share it with, because I'm not able to give this access to everyone. Again, because of the rules and regulations, I am not able to expose this group to many people. So this won't be for everyone. This is for you. If you want to see how I grow $1,000 to $10,000, you can deposit at least $500 to $1,000 to follow along. No doubt we are on week 2, but you still can catch up because it's still going to be the same. You will be actively participating to learn and to grow. Now, just to set the context, this is not a signal channel. This is an educational channel where I'm sharing my personal entries, and everything that I share will reflect my personal trades that I only take, and views for education only. Nothing that I will share would be financial advice or recommendation. You are responsible for your own decisions and for your own risk. Understand that when you deposit money, you will be having full control of your own account, and therefore, if you profit, it will be yours to keep. I don't take any of your profits, and also this is not a copy trade where there is a master account and slave accounts, and when I enter, the slave account automatically copies the trades. It is not a copy trade. You are responsible to take your own trades. However, this group will be for traders using the same trading account set up with me. And the idea is that we are all operating under the same conditions. Also, when I mentioned that you need to actively participate, I don't expect you to catch every single trade that I take, but try to follow most setups if you want to. I also want you to share your wins with me so that I know that you are actively participating along and you are also growing your account. The main reason that I do that is for tracking purposes, because I want to be able to know whether you're on the right track, whether you're growing the account, and therefore I can give you feedback accordingly as well. Now, I don't guarantee that when you do this, you'll be able to grow your account from $1,000 to $10,000, just like I do, because even when I share, it may not mean that you enter at the same time. It may not mean that you close at the same time. Maybe you miss the trades. Maybe you fumble here and there. I'm not sure. I cannot also guarantee that I won't make mistakes myself or there will not be any losses. Maybe I may blow the account before I reach $10,000. Who knows? But what is certain is that I won't give up. And if I fail, I will do it again until I reach the target, which also means that this $1,000 that I put into this journey is not my entire life savings. This is money that I'm willing to lose. And if this $1,000 is gone, I will have many more $1,000 to top up. But if I fail 3 times, lose $3,000, but in the end I grow it to $10,000, is it still worth it? I should think so. And what I'm certain for you is that this is going to be a learning journey for you as well. Maybe $10,000 will be the first milestone. When we reach there, who knows? I might even go to 50K, 100K, so on and so forth. But the main thing is that you get to learn from this journey. Here's the thing, I cannot be promoting a broker to you because of the rules and regulations. But if you want to join, what you can do is you can DM me on Telegram. Make sure that the name matches exactly as the spelling that you see right here, because there are a lot of impersonators out there. You don't want to be messaging the wrong person. DM this account with this message that you see there. I will vet through, and if you're selected, I will give you the opportunity and the access to join me in the journey. So there you go. I've shared 2 amazing strategies that you can use in order to scout for gold. And if this video was helpful, guys, help me out. Comment down below what you thought was valuable for you. What are some of the lessons that you learned from this video? And I hope that I will be able to produce more videos like this. If you have any ideas what kind of content you would love to see, let me know in the comment section below as well, because after all, I'm creating videos like this for you guys to watch. So with that said, give me a thumbs up, subscribe if you have not done so, and if you want to see how I turned $82 into $10,000, just click the video link somewhere around here, and I look forward to seeing you in the next video. Bye bye.